For long-term goals like retirement, tax-advantaged accounts are crucial. In the U.S., common options include employer-sponsored 401ks and individual IRAs. Contributions to traditional 401ks or IRAs use pre-tax dollars, lowering your current taxable income. Investments grow tax-deferred, with taxes paid upon withdrawal and retirement. Roth versions are funded with after-tax money, offering no immediate tax break. However, investments grow completely tax-free, and qualified retirement withdrawals are also tax-free. Maximizing contributions to these accounts is a top priority, as their tax benefits compound dramatically over decades. To avoid picking individual stocks, many investors use mutual funds and ETFs. These pooled vehicles hold a basket of securities for instant diversification. A mutual fund is professionally managed, with shares bought at the end-of-day price. An ETF trades on an exchange like a stock, with prices fluctuating all day. Their primary advantage is reducing risk through diversification. One share of a total stock market fund gives you ownership in thousands of companies. Stocks represent ownership in a company, offering high growth potential with higher risk. Your investment's value rises and falls with the company's performance. Bonds are loans to a corporation or government. They provide regular interest and are generally lower risk, but with lower growth potential than stocks. For most beginners, a balanced mix of both is key to building a portfolio aligned with your risk tolerance and time horizon. Social Security provides a foundation of retirement income based on your lifetime earnings. Your benefit is calculated from your highest 35 years of earnings. You can start benefits as early as 62, but payments are permanently reduced. Waiting until your full retirement age, 66 to 67, yields your full primary insurance amount. Delaying benefits past your FRA, up to age 70, increases your monthly payment for life. Remember, it's designed to supplement your personal savings, not replace all income. IRAs are key for tax-advantaged savings, especially without a 401k. The two main types are the traditional IRA and the Roth IRA. With a traditional IRA, contributions may be tax-deductible, and growth is tax-deferred. Roth IRA contributions use after-tax dollars, but qualified withdrawals are tax-free. IRAs offer wide investment choices but have lower annual limits than 401ks. Your choice often depends on whether you expect a higher tax rate now or in retirement. A 401k is powerful for its tax advantages and frequent employer match. Traditional contributions reduce your current taxable income and grow tax-deferred. Always contribute enough to get your employer's full matching contribution. It's free money. Be mindful of annual IRS contribution limits and early withdrawal penalties. Integrate daily habits with long-term pillars. Your budget should allocate funds for retirement, taxes, and estate planning, not just monthly bills. Automate contributions to investment accounts right after payday. Schedule an annual financial review to reassess your budget, portfolio, and estate documents. Estate planning dictates what happens to your assets and dependents. At a minimum, create a will to distribute possessions and name guardians for children. Establish durable powers of attorney for finances and healthcare. A revocable living trust can help avoid the public probate process. Proactive tax planning legally minimizes your lifetime tax burden. Strategically use tax-advantaged accounts and be mindful of capital gains taxes. Adjust your W-4 withholdings at work if you consistently receive large refunds or owe money. Your goal should be to break even. Homeowners insurance should cover rebuilding costs, not just market value. Renter's insurance is affordable and covers your property and liability. Your landlord's policy does not. For both, a higher deductible lowers your premium. Life insurance, like term life, provides for dependents and is affordable for covering specific needs. Auto insurance requires understanding coverage levels. Increase liability limits above low state minimums for better protection. Consider your car's value when choosing collision and comprehensive coverage. Uninsured motorist coverage protects you if hit by someone with insufficient insurance. Health insurance protects you from catastrophic medical debt. Understand key terms: premium, deductible, copays, and coinsurance. A higher deductible usually means a lower premium. Always check that your preferred doctors and hospitals are in network to avoid higher charges. Start by defining clear long-term goals. Then, work backward to establish the necessary monthly savings rate, using online calculators or an advisor. Automate these savings transfers immediately after each paycheck. This is the most powerful habit. Your daily spending then occurs within the remaining budget. Create a one-page financial dashboard listing your net worth, debts, and key documents. Review this quarterly to ensure daily spending funds your envisioned future. Estate planning ensures your savings benefit the people you care about. It starts with a will to direct asset distribution and name guardians. Keep beneficiary designations on accounts like 401(k)s and life insurance updated, as they override a will. Establish powers of attorney and a healthcare directive. Consolidate this review annually, perhaps during tax season, to verify all beneficiaries and ensure documents are accessible to trusted family members. You are taxed on what you earn, invest, and leave behind. Maximize contributions to tax-advantaged accounts like 401(k)s and IRAs. For non-retirement goals, consider tax implications. Holding investments over a year typically qualifies for lower long-term capital gains rates. Do an annual tax checkup with your pay stubs and investment statements. Ensure proper withholdings to avoid a large bill or a missed investment opportunity.